Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our once every 3 weeks members only workshop. Let's get started. All right, let's make a quick run through our agenda here. We will talk a little bit about what's going on in InvestorsObserver, talk about what's going on in the market, and then the rest of the time is what we call member-driven content, which is questions from you. You can submit questions at any point by using the question box. If it's relevant to what I'm talking about at the moment, I will sometimes get to it then. Otherwise, we have plenty of time for questions and answers at the end. You can always submit questions ahead of time, just mention the workshop, or even just reply to the invitation. We got a number of those this time. Thank you to everybody who submitted submitted questions. We've got slides for a bunch of those lined up already. All right, so what's going on in InvestorsObserver? We don't have, well, I guess since the last time we talked, we've launched our portfolio tracker. We've had pretty good response to that. If you don't know where it is on the website right here. You can go to My Portfolio and link a portfolio from there. It's a pretty neat tool. It'll give you scores for your portfolio. It dollar weights everything. There we are. Yeah, it dollar weights all the things in your portfolio and gives you our scores for those things and for the, for your portfolio. So that's pretty cool. Check it out. Let us know if you have any questions. The linking is all done through a service called Plaid, which is owned by Visa and offers, full on like bank level security. We don't have any access to your account other than what is pulled and then handed to us by Plaid. We certainly can't put anything in your account, can't make any trades, no access like that. If you're concerned about that sort of thing. All right, so let's talk about what's going on in the market. Let me get this back to full screen. All right, so this chart is 2 years of daily candles. I went out to 2 years just so I could kind of show that there is some pretty good support between 30, 50, and 3,000. This chart didn't capture the last 20 minutes or so of the market today, just because I had to pull the chart before this started. But it's pretty close. So yeah, we're sort of getting close to a level. We may be able to fall a little bit further before we hit that support, but there is some support there. And then obviously these more recent lows also should help things if we keep going down through that 3,000 level. All right, so this is 6 months of daily candles minus today, so through yesterday. And the reason I did that is I kind of wanted to show this group of candlesticks here, which is sort of an island. An island is really, I think technically it's any group of candles that is sort of separate from something else. So, this group here, this group here could be an island. But this island here is interesting because it's sort of between a couple things, right? There's this gap here when we fell, and there's this gap here when we came back up, and then we just traded in between that range for a while, and then it seems like maybe we fell out of that today and sort of reconnected these things at least and closed that gap. So yeah, let's go. So this is the same chart, but with most of today's candle added. And so there's a couple things that are sort of interesting here. One is this move to the downside could actually be a bullish sign. We closed the gap that was created with this move from here to here overnight. And sometimes, a gap fill, as that's called, can be a reversal. So we set a series of sort of lower lows here, but we filled this gap and now things could go the other way. I don't know. It turns out that fundamentals tend to trump technicals most of the time. But it has been sort of, we've been sort of watching this island in this tight range for the last few days to see which way it would go, because it had to go one way or the other. You're not going to stay in that tight of a range forever. Another thing that's worth noting here, we talked about this in, I think, our weekend review post on Friday of last week, is that since this big drop on June the 8th, the sort of tone of the market has changed. We talked about it when we started to recover in terms of the initial stages of the recovery were led by big tech. And then some other things started to come in. Well, since the 8th of June, when we dropped off the cliff here, we're back to, that sort of March market. Finance is down. The finance ETF since June 8th is down 13.5%. Energy is down 20. Industrials are down 12. Real estate's down 10.5. The tech sector ETF, the XLK, is only up like 0.6%, but in there, Apple is up 8.5%, Microsoft is up more than 5%. It's a real sort of, right, like move back into that sort of stay-at-home trade, as we were calling it. And so that's kind of an interesting thing to watch. And that this all coincides with the big spikes in coronavirus cases we've seen in like Texas, California, Arizona, Florida, a few other states. So it's right. It seems like this is sort of a repositioning towards the sort of, dealing with this for longer as opposed to a quick recovery. All right. So what else is happening, or what is happening? Uncertainty is everywhere has sort of been a theme for the last. I'm not sure how long that bullet. Yeah, I just don't change that bullet. What's under it ends up changing. But yeah, this whole cycle from, sort of late February into March, and then the recovery has really happened more than, or faster than traditional economic data can measure. We were still learning about how deep the, the fall in things like employment was as things had already started to recover. Another important thing to remember is that data is backward looking and the market is forward looking, right? I mean, markets don't really care what you did yesterday. Markets care what you're going to do tomorrow. You can see this a lot during earnings season, right? A company can miss earnings, but if the guidance is good, the stock will usually do a lot better, especially when compared to a case where, say, the, company hits earnings estimates, but lowers their guidance. That's usually a lot worse. And so what people are looking at now, in addition to the regular data, is some sort of alternative data that moves a lot faster. And we'll go through some of this. We've got some slides on a couple of these prepared for the next couple of slides. But Jpmorgan is publishing a spending tracker. JPM has a massive, number of credit cards. Assuming they have a relatively representative sample, those trends should hold. The TSA is publishing daily passenger data, so people are looking at that. And then OpenTable, which does a lot of both restaurant reservations, and they also provide some systems that do like point of sale devices for restaurants. So that there's that data. And then Apple has some what they're calling mobility data, where basically they can kind of tell what you're doing based on your phone, and they aggregate all that together. It's pretty, I mean, you can Google any of these. Yeah, the spending tracker is a little bit harder to find, but if you Google like TSA passenger data or OpenTable restaurant data or Apple mobility data, you can see those. And the Apple in particular, you can type in almost any city, and it'll give you some data for it. So that's kind of interesting. And then, yeah, the other thing that we're, sort of learning, and as we look at all this, is reopening is a process. At this point, there's a real patchwork of rules across states and localities. Just because, and also, as we'll see in a few minutes, looking at some of this data, just because things are open doesn't mean people will go. And so that's another thing to sort of, keep an eye on and be mindful of as we're, trying to figure out how to get through this. Is that, yeah, just because things reopen doesn't mean people are going to go. Back open doesn't necessarily mean back in business, and is, potentially very different from back in business operating at a profitable level. All right, so there are a couple of other interesting things that we're watching. Trade with China. China made some noises earlier this week about trying to increase agricultural purchases. They're almost certainly not going to hit their targets for that deal. They've bought, I forget what the number is, somewhere around 20% of what they're supposed to buy this year, and we're halfway through the year. It seems unlikely they're going to catch up with that. Now, the interesting thing about that is the White House seems to measure the economy by looking at the stock market. Given how the stock market has reacted to tariffs in the past, especially tariffs on China in the past, will they put tariffs on again 4 months before a presidential election? Our guess is no. Predicting this particular White House has been kind of not a smart move, just even trying it. But that kind of is our guess in terms of what we think is the most likely outcome. Trade with Europe is also now a potential sort of flashpoint. That there's a long-running dispute between the U.S. and the EU about airplanes. The EU subsidizes Airbus, which is the big European airplane maker, directly. Meanwhile, in the United States, there are a lot of contracts that go to Boeing because they're defense contracts, and there's basically nobody else who can fulfill that contract. So Boeing sort of gets those things without Airbus even being allowed to participate. The EU says the US system is anti-competitive. The US says the European system is anti-competitive. So we have this sort of long-running thing here, and the administration has threatened either higher tariffs or new tariffs, depending on which goods you're talking about, on Europe because of that. An interesting thing about this, a lot of those EU exports are wine, spirits, cheeses, olives and olive oil. It's a lot of food products. There are some other things, but it's a lot of food products, which is going to hit both consumers and the restaurant industry in particular pretty hard if that happens, right? I mean, you're already dealing with, I went to the grocery store yesterday. Prices are up for a lot of things just because there have been shortages in terms of, we talked a few weeks ago about the shutdowns of processing plants and things like that. That leads to shortages further down the chain. Some meat products and stuff like that, the grocery store near me just didn't have. And that's fine, but if you're running a restaurant, not having food is no way to run a restaurant. So you either have to pay whatever it costs, or you just don't have that, which is tough. And then the cost of other things that you can get going up makes that hard. And then also the EU is likely to retaliate in some fashion. I don't know exactly what that would be. But again, it makes goods coming from the US to Europe less competitive, which is probably not great for the sales of those goods. All right, so let's talk about some of that fast data. There's a whole bunch of charts in that Jpmorgan spending tracker. This is the headline here. It's a little bit delayed, so June 20 is the most recent one that's publicly available. So this is the change from a year ago, basically. So as you would expect, because economies grow early in the year, card spending was ahead of where it was a year ago. and then it fell off a cliff, and it's been sort of slowly and bumpily making its way back up. We are now down 10.7% from where we were on June 20 of last year. It's a 3.2% increase over the prior week, and up quite a few points above the low. All right, so digging in, they have tons of these charts. I only included a few of them here. They have, breakdowns by generation and state and all kinds of stuff. But these I think are interesting for a bunch of reasons. So you can see here there are some categories where things are up and some categories where things that are down. This is another set of sort of businesses. These big spikes here, I don't know if you remember the, back in the spring when everybody was hoarding toilet paper and everything they could get their hands on. These big spikes in supermarkets and wholesale clubs, that's what it looks like in this data when everybody goes to Costco and buys all the toilet paper at once. You get this huge jump. And so you can see the supermarkets, wholesale clubs, those are doing well. Other retail is, a lot of that is Amazon. I'm not sure exactly what's in this category. I know in some of the some of the Commerce Department data, other retail is almost exclusively Amazon. And so, yeah, you would expect after a big jump like this, the consumption of staples would go down and then normalize. So that's what you see here. And you see some other stuff is starting to come back. Restaurants are still down more than 30%. Pharmacies are starting to come back. But then over here, you start to see things like spending at gas stations is down by more than 25%. Lodging, airlines, travel, all the things you would expect to not be coming back as fast or not coming back as fast, it turns out. There's no huge shocks there, but it is interesting to see exactly how far down it is. All right. And then this is, so consumer card spending by card presence. So in the credit card processing world, there are what's called card present transactions and card not present transactions. Card present transactions is when you're there and you swipe your card or stick the chip in or tap it on the machine. Any of those things where your card is actually coming in contact with a point of sale device. That's card present, right? It typically means that you are present in a place making a transaction. Card not present is all your virtual transactions, right? So App Store spending, Amazon, any of those sorts of things. And so here they actually backed out your non-recurring categories. So they can flag subscription spending. So Netflix, InvestorsObserver, all those things you might subscribe to online are sort of backed out of this. So this is really just, it's people buying things and much fewer subscriptions. And so you see the card not present has recovered and actually grown a little bit. And again, right, not surprising, people start buying a lot more stuff online. Yeah, I don't have the chops to do it and I don't have the raw data, but it would be interesting to see how this lines up with that big bump that we looked at back here. My guess is as people stopped going to the supermarket and the wholesale store, that's when some of this climb started to happen. Amazon was also just sort of anecdotally out of a lot of stuff for a while. You would expect that sort of card not present stuff to ramp up a lot faster once Amazon got sort of resupplied. And yeah, this may not state the state of things entirely because right. So this 10% drop here may not, right. I don't necessarily think that consumer spending is only down by 10%, and the reason for that is sort of illustrated here in the sense that, well, if you got minus 20 here and plus 6 here, that doesn't add up to minus 10. And then also this doesn't account for any cash transactions. And by sort of definitionally, cash transactions aren't going to be virtual. So you got to figure that cash transactions are probably down by at least 20% in the same way that card present transactions are down by 20%. So in terms of trying to figure out where we are in terms of the economy and some reference to normal, it's down probably more than 10%, but card spending is down, between 10 and 11. All right, so this was, I thought, an interesting chart. It's consumer spending by stay-at-home order status. And getting back to the point I tried to make earlier about just because things are open doesn't mean people are going to go. Well, there's three categories here. There's never had a stay-in-place, never had a stay-at-home order. The stay-at-home order was lifted by March the 18th, which is roughly here, or the order was still in place on, or sorry, not March the 18th, May the 18th, or order was still in place on May the 19th. And those lines all track together. Right, the order lifted states, even when the orders were still on, were spending higher than the never had a stay in place order states. What does that tell you? It tells you that people are going to do things. People may make decisions about their own health and safety that are not necessarily right. You don't have to close all the stores to get people to stop going to the stores, is really what this tells you. So that's another chart that we thought was interesting. All right, so let's move into the TSA data a little bit here. So this is from, I forget exactly when this starts, but I think it's somewhere toward the end of January. And so this is just passengers passing through the TSA per day. And you can see it just drops off a cliff. For reference, the year ago numbers for this time of year are around 2.5 million. And we've just started to break above 500,000 per day, a few days a week in the last week or so. And the red line there is just a 7-day average. So you can kind of get a little smoother idea. So yeah, we're, if we're at 2.5 million a year ago, we're at 500,000 now. That's 20% of the year ago volume. And again, economies tend to grow, so you would expect that to be higher, all things being equal. And so this one's a little bit hard to explain, but so what this is the daily rate of change in the 7-day average. So I like the 7-day average because it's just a lot smoother, right? Looking at the daily, which is the blue columns here, it's real noisy. So you do a 7-day average and you get a lot smoother line and you can get a trend. And so this chart is basically how much that 7-day average goes up or down every day. So here it went down, whatever that would be, we'll call that 17%. And here it was up probably somewhere around 5%. And so what you see here is things started to come back in a hurry. Expect a bigger percentage change off a lower base, but the growth rate has really slowed down. It's noisy, but the growth rate is decidedly low. And if we're at 20% of normal, adding 1 or 2% a day, it takes a real long time to get back to sort of fully open. And yeah, okay, so I didn't pull anything from the Apple data or the Open Table data. They show similar things. You can look at some cities, and try to discern some patterns, but it's generally just a lot noisier and hard to figure out exactly what's going on from those particular sets of data. But they are interesting to look at and will give you a broad idea of sort of where things are, but it's a little bit harder to determine any sort of trend. All right, so I wanted to do a quick review of just sort of a covered call and how do they work. I've gotten sort of a lot of questions about this recently. There's, tons of new investors coming into the market all the time. So just wanted to go over this. And for the record, Live Long Corporation, stock ticker LLC, is completely made up. I just needed something for an example. But the principle is the same. So in this case, we're going to buy the stock for $51.96, and we're going to sell an August 55 call for 84 cents. That gives us a net debit, which is the price of the stock less we're selling the call. So what we're bringing in this 84 cents. This is coming to us. This is going out. So the net is 51.12. And so here's the stock price. Here is our actual cost to enter. Oops, sorry, and break-even price. And then the stock, right? The strike price of our call is up here. So if the stock is above 55 at expiration, we sell the stock at 55, right? The option is assigned, we sell the stock. That's how that works. We make a profit of 388. That's 55 minus 51.12. If the stock is below 55, the option expires worthless. We keep the stock, we keep the $84 because remember, one contract of an option covers 100 shares. So you multiply the sort of per share price here of 84 cents by 100 to get the actual amount of money. And then, yeah, if the stock falls sharply while the trade is open, the price of the option also drops and you can repurchase it. We'll talk about this more in a second in the Q&A, but that's how that works. So yeah, what a covered call does is it trades away the upside, right? If the stock goes to 75, we only participate up to 55. And this is a pretty small number. We could structure this differently to have a lot more downside protection, but our cost to enter this position is more than 1.5% lower than the current stock price. And so even if the stock stays perfectly flat here, we actually make a little bit of money because we collected this premium for selling the option. And you can also, right, this math works the same. You can also sell a call that is below the current price of the stock. You just get a lot more premium that way. And so what you care about is your break-even point less than the strike price of the stock? And if it is, then that's a profitable trade, even if the stock doesn't go anywhere. All right, so let's get into the questions. This one is from Douglas. He says, how do you handle covered calls that have A, blown through the strike price by 1 point or more, and you are, let's say, 1 to 4 weeks from expiration? And then B, is buying back the call and then selling another call ever a good strategy? So the thing about a covered call is it's short time value, right? Remember, we sold that option. And so pretty much anytime you start a trade with a sale, you're short whatever it is you sold, right? Because buy low, sell high still works, but if you do the selling first, you're hoping to buy later at a lower price. So it's still a short trade. And so in this case, we're short the option, and the option has what's called time value, and that time value goes down every day until expiration when it hits 0. And so a covered call is a trade that is short time value. And the other thing here is if it only blows through it by a point or two, that's not very much. You're still talking about an at-the-money option. And so that's where the time value is the highest. So time value is a way to think about time value as a measure of uncertainty. So if you think of a option as a contract to buy a stock at a price, you only want to buy the stock at that price. This is a call option. You only want to buy the stock at that price if the market price of the stock is higher, right? If I have an option to buy a stock at 55, but I can buy it on the market for 52, why would I exercise the option? I'm paying $3 extra for no reason. And so that time value is a measure of uncertainty. And what causes uncertainty is time and where the stock is relative to the strike price. So if the stock is very close to that 55, whether the stock will expire above or below 55 is really uncertain. But if the stock goes to 35, well, now 55 is a pretty long way away. There's not a lot of uncertainty there, right? It seems more likely than not that the stock will be below 55. If the stock goes to 75, well, now that's pretty far away. There's not a lot of uncertainty about that either. Okay, so right around the money, whether it's a couple bucks in or a couple bucks out, or a couple percent in or a couple percent out, really doesn't matter. It's still basically at the money, which is where time value is the highest. And so the other thing to remember about options is time value decays on a curve. So it decays on a percentage basis fastest right before expiration. And again, this makes perfect sense if you think about it in terms of measuring uncertainty. So if you have 5 days left, the difference between 5 days and 4 days is you went from 5 units to 4 units is a loss of 20%. So 20% of the price falls out from day 5 to day 4. Now, if you go from 2 days to 1 days, well, now you just lost 50% of the time. And so you should see a 50% drop in time value for that. So that last, I mean, yeah, the difference between 1 to 4 weeks in terms of time value is massive. A month of time value versus a week of time value, you can see a very big difference there. So those are some of the things I would think about in terms of this question. Now, we will typically consider repurchasing the option if the stock has fallen. Again, the stock goes way down, takes a lot of uncertainty around where things are. You can buy back the option for cheap. We're short the option, right? Like if the option goes to 0, we might as well close the short part of the trade anyway. We're still long the stock. We're probably underwater on that, but we can realize a profit on the option part of that trade. Okay, so the same math basically applies when the stock is up by a lot. The difference is the intrinsic value, how far in the money that option is now part of the option's price. So if that stock goes to 75 and we have a $55 option, it's going to cost you 20 bucks to buy that option back because the option is 20 bucks in the money. Now, what that does is basically it takes 20 bucks in cash, closes the short on the option that's underwater by something approximating 20 bucks and unlocks the change in stock price. The net change, there should be very little net change in your account from doing that. You're basically taking cash and covering a hole that's caused by the option, and that lets you realize the $20 profit in the stock. But the only real reason that I've ever been able to determine you would want to do that is for tax purposes. Right? If you just don't want to sell the stock because you maybe have a big gain on it, it might make sense to buy that option back. But otherwise, I mean, yeah, if you're just trading and don't care what the stock is, I've never really been convinced of any good reason to roll a deep in the money option in order just to hang on to the stock. I think the tax reason is the only real good reason to do that. And yeah, I can't tell you much more than that because taxes are complicated and individual, and there's no good rules that apply to everybody in terms of that. But yeah, so rolling can work, but typically we do it as part of a position repair strategy. And I think there's a question coming up about that. But yeah, so if the stock falls a lot, then by all means, buy back a near-term option for cheap and sell one further out for a little bit more. Like, why not? And I think that's what this next question is about. Yeah, so this one is from Jeff. He says, thanks for all your help. Yesterday, I purchased 100 shares of SE in the mid-113s and sold a 113 call. Today, it's trading in the mid-104s. Can we address a situation where the stock falls so far, so fast? It's actually far enough that he bought back the 113 call for pennies and sold a 108. So, yeah, I mean, like I said, we've done this in terms of defense. It typically doesn't happen quite this fast in terms of the next day, but this isn't really a normal market. So that kind of is what it is. But yeah, so if we go through this was the trade in yesterday's morning update. The net debit here was around 108.62. I don't know exactly what price Jeff got. 108.62 was the net debit in the morning update. And again, I'm not sure exactly where the 108 call was when Jeff bought his option back and then sold another one. SE was down to like 100 today and then back up to somewhere around 105 at one point. Anyway, so the 108 call, I don't know what the expiration there is exactly, but the July was going for $5. So if we sold the 113 yesterday and bought it back for pennies today and then sold the 108 today for $5, our net debit is now down to 103.65. So, right, the stock was at 113 yesterday. Our break even is now somewhere around here. And this is exactly how we've handled these sorts of things in portfolios in the past. I've done things like this in my personal account in the past. Yeah, as long as you can make sure that the strike price of the option you're selling, in this case 108, is above essentially the cost of buying the stock minus what you've paid or received for every call transaction, right? So add and subtract all those call prices together in terms of credits and debits, subtract that from the stock price. If that number is less than the strike price of your option, you're looking at a potentially profitable trade. Yeah, that's exactly how we've handled that in the past. I mean, if it falls too much further, you can get in a sticky situation where there isn't an option you can sell where that break-even math is positive. In that case, you can do something like pick one that's far enough out of the money that it seems unlikely to get there. But that's it's taking a little bit of a risk in that regard. All right, so this next question was from Theo. He said, is it best to sell or hold shares in Volaris? Yeah, these notes don't belong with this question. I just didn't clean up my slides very well. All right, so let's just go look at the website in terms of answering this question. That seems like the best way to do that anyway. All right, so Volaris is, I believe, VAL. Yeah, so Volaris is deepwater drilling, it looks like. It ran way up here for reasons I couldn't tell you. I guess we could try to look at the news and see what happened in early June. It's one of those. Yeah, so this is a trend I can't really explain, but so here we have on June 1, company skips a couple of interest payments and is talking to creditors about restructuring, which, yeah, skipped another interest payment 2 weeks later. So this is a company that looks like it might be headed for bankruptcy. I can't explain this rally any more than I can explain the rally in actual bankrupt companies like Hertz or Whiting Petroleum. It makes no sense to me. For a company in bankruptcy, the stock is essentially a call option on the debt. So what I mean by that is when a company goes into bankruptcy, stockholders are the last in line to get paid back. So what happens is they sell things, they make cuts, they try to do whatever they can, and the bondholders are in charge, right? The people who have loaned money to the company are in charge. And if there's any money left over after all of those people get paid back, that value goes to shareholders. So Whiting Petroleum, which is WLL, for example, they made an agreement sort of before they entered bankruptcy that on the other side, shareholders might get about 3% of the company back. And so, yeah, personally, this is a stay away from me. One thing I will point out here is the average analyst recommendation is a sell, and the mean target is 291, which is way above the current price. And the reason for that is not that analysts think it's going to go back to 291. The reason is probably analysts decide it was a sell back early in the year, put a real low price target on it, and it's a sell, and the company's going to go bankrupt, and they just don't care enough to update the price target. And so that's why you see this. And it looks the average analyst thinks it's going to go up 300%. That's not really true. Unfortunately, we don't have a good way to screen for that kind of data and clean it up. So we do have these sort of artifacts of this on our site, but yeah, I don't think any analyst at this point actually expects the stock to go to 291. It's really just a function of they slapped a sell on it, the company looks like it's going to go bankrupt, and they have better things to do than update their price targets. All right, so that is the end of the prepared questions. Thank you to everybody who sent in a question ahead of time. We'll go back and see what other questions people have submitted as we go. So George says he wonders if the uptick in TSA is due to people and businesses relocating away from high tax and unsafe cities. George, I don't really think so. I mean, yeah, airports are in cities. If you really want to go away from cities, you don't go to the airport. You probably rent a car or something would be my guess. And I don't think it's only been going on for a couple of months. I don't really see a lot of that happening just yet. Also, cities are generally where the workers are. And so if you, I mean, if you want to decide you want to go incorporate in, you know, rural Nebraska or somewhere where there's no people and have everybody work remotely, that's fine. But nobody's getting on an airplane because you relocated your company somewhere and didn't move any workforce. So I don't really think that's it. I think it's coming back because people are traveling more. One interesting thing we noticed earlier this week was that like Spirit and Frontier and Allegiant, some of the sort of lower tier airlines, let's say, we're all increasing flights faster than, you know, the old line carriers, your Deltas and Uniteds and Americans, things like that. And the difference there is those are all almost exclusively leisure travel. Right, most business travelers are booking the legacy carriers, whereas, yeah, I mean, if your work, yeah, I've flown Frontier. If your work is paying for it, you're not flying Frontier. So that's some of the difference areas. It really seems like it's an uptick in leisure travel, which again makes it very susceptible to changes in the you know, people's behavior and virus things. All right. All right, so a couple questions about that mean price. Typically, the prices are 12 months. So, you know, it's what the average of what Wall Street thinks it will be about a year from now. And because it's an average of a number of estimates, we can't really put a date on it because it's right. I mean, I guess we could average the dates of all the estimates, but that's not really all that useful either. And yes, the average, the mean average, that it is the sort of target. And that's Wall Street's number. That's not our number. We don't do target prices here, but we do think it's valuable, particularly if you aggregate a bunch of people's recommendations. All right, so Danny has a question. He says, can we help find high IV percentile trades to enter credit spreads, new to options and struggling to find high probability spreads? So I'm going to do a thing that everybody hates and argue with the premise of your question a little bit. And essentially where I would argue is you say high IV trades, and then you want to find high probability spreads. So IV is implied volatility, which is, to try to make this short, options are priced based on a model. Right, there's a whole bunch of inputs and there's a model that falls out in terms of how all the inputs work together. And the things that fall out are the Greeks. And so if you have an equation with 6 inputs, you can solve for any one of those independently. And that is essentially what the model does. And so implied volatility is one of those, and it really measures sort of the difference between the amount of volatility in the stock that's predicted by the price of a given option and what volatility in that stock has been historically. So when you have a high IV option, what you're looking at is an option where the option market, for some reason, is pricing in a lot of volatility in the stock. That's not necessarily a high probability spread in terms of winning. And so what I would suggest you can do is use our option screener We have bullish and bearish credit spreads, and under, I think it's under risk management. Yes, so you can look at the out of the money percentage and also the probability of expiring worthless. So probability of expiring worthless is actually based on the delta. Let's just do this. Yeah, you can even sort by this column. And what you'll notice here is a couple of things. Well, yeah, there's even more things than I was originally. So high probability of expiring worthless, right? These trades are going to be pretty far out of the money, which makes sense, right? The stock has to move a lot further to get to the strike price, which is what we don't want to happen. So if it's 22% of the money, these are also going to be stocks that are relatively volatile. And the reason for that is you get higher premiums that way. And so what you may want to try to do is find sort of a happy medium between right, so yeah, if you sort by downside protection, you get a lot of the same names here at the top that you get if you sort by, that was the wrong column. Yeah, then if you sort by probability of expiring worthless. So yeah, these things are pretty far out of the money, but they're also pretty volatile. So those may be okay. And then if you look at the, assigned return rate, these are also going to be not bad. Some of these you're actually managing to make more than you have at risk, which is kind of an interesting trade. May not be able to get those. I'd have to dig into the pricing there, but and then you can also sort by days to expiration. Here is the other piece, and I would, if it were me and I was looking for the highest probability trade possible, I would put in some key rating minimums of probably at least 3, and that'll take away a lot of those 200-day away trades. So key ratings are our measure of the risk of the trade. It does not consider the direction of the stock. So if you want a stock that we think is going to go up, has the highest probability of going up, that's where you're going to look at the overall score. If you want a trade that has, strikes are close together, low bid-ask spreads, it's not a very long trade, that's going to be your key ratings. So you sort by key ratings and get the 5s at the top. You'll see these have a lower probability of expiring worthless than some of those names we were looking at before, but these are also, 9 days away. There's a couple of 24s. This is a much friendlier looking set of names here in terms of what I would look at in terms of high probability options or option trades. High IV is that first group we were looking at where it's stocks that could go anywhere. Right, the market is pricing in a lot of volatility. Chris, I don't have a recommendation for candlestick books. You can go as deep as you want there. I have a very rudimentary sort of understanding of it. I know a few things, and a lot of times what happens is I'll see something that looks interesting and Google it. But yeah, I don't have a specific book that I can recommend. I've read a lot of sort of one-off articles about individual patterns. Investopedia has a few pieces about candlestick analysis and specific patterns and things like that. But I've never actually read an entire book on the subject. Okay. All right, we have a question on WKHS. All right, so yeah, this company, I can't really speak to the underlying quality of this company. They're in the electric car business, and if you look at, say, Tesla, or perhaps even more instructive, this company, Nikola, right? This is a company that has not ever sold a single truck. There is actually some debate about whether their prototype truck actually drove itself onto a stage or was pushed there. And yet it has a market capitalization of 27 billion. That may be a bet that pays off. I don't know. It is a very risky bet. And so this is a stock that I had never heard of until probably 2 weeks ago. Maybe more recently than that. The weeks all kind of run together at this point. And so, yeah, it may be a good bet, but yeah, man, I don't know. It's gone from $2 to $8.50 in like 3 weeks. And the news driving that is okay. So they got a van approved. It looks like passed the safety test. We got some other experimental things apparently. Yeah, I mean, this is a very early stage company. They're also not selling these automobiles. They're just getting sort of regulatory approvals and things like that. Yeah, I don't see anything here that gives me a reason for this stock to more than triple in 2 weeks. Yeah, I saw, yeah, George. Yes, somebody did order 1,200 trucks from them. But yeah, they haven't delivered any trucks yet. I don't know that that order came with any cash up front. And yeah, I don't know. Anytime a stock triples in 3 weeks and there's no like, we just solved the world's energy problems or something like that, I get a little nervous about it. Sometimes it can pay off, but most of the time it doesn't. Yeah, that's all I can really offer on that one. It just seems bananas. Sometimes things go up like that and never look back, but most of the time they come back to earth and they come back pretty hard. All right, so here's a good question from Chris. He says, do you have any concerns that the tech cloud data companies are too far overbought or overpriced and there'll be a bigger correction? Maybe at upcoming earnings. It's possible. I don't know that it would correlate with earnings. And the reason for that is assuming they hit their guidance, and provide, some reasonable explanation for future expectations that aren't abjectly terrible. I don't see any reason for that to be a trigger for selling. You do wonder, right? I mean, Apple's at an all-time high, and it certainly seems like the economy is going to be not as good. Yeah, I mean, if you had to make a prediction now about how many units, how many things Apple will sell in the next 5 years, it would probably be a lower number than the prediction you would have made in January. And so if you think their earnings are going to be less over the next 5 years, why would the stock be priced higher than it was in January? That's a question I can't answer. I mean, the other side of that coin, though, is people are going to invest money somewhere. And even on a dividend basis, Apple doesn't look too bad. I don't know what exactly their dividend is at the current price. Yeah, it's under 1%. That's still better than 10-year treasuries. Or maybe it's about the same as 10-year treasuries. In any case, money has to go somewhere. I don't know. Yeah, I don't expect Apple and Microsoft to go broke. If the entire market turns south again or something like that, there certainly could be a correction. I'm just not sure what it would take. To be honest, I am a little bit torn between the idea that money has to go somewhere, and I can't imagine why money would keep going here. Because I'm not sure where else money would go either. People are trying to put money in places where they think they can get a return, and it doesn't look very much like bonds is the answer to that question right now. All right, let's see. I'll get to this last question from George, and I think that's probably all we have time for. So how should I use the overall score and the sentiment score to compare stocks? So the overall score is an aggregation of our short-term technical, long-term technical, and fundamental scores. It's really meant as a starting point. It's not a bad place to start. Certainly if you're looking for stocks that are, sort of meet the basic criteria of being, pretty, being pretty healthy across the board. The overall score is not a bad place to start. Sentiment is sort of the opposite. Sentiment is the absolute shortest indicator we have. Sentiment looks at what a stock has done in the last 5 days in terms of price and volume. And so, yeah, those are very different. If you want to know, if you're a short-term trader and you know what stocks are going up, sentiment is a great place to start. If you have a longer, sort of more holistic approach to investing, then the overall score is a good place to start. And then, the analyst ranking, valuation, fundamental, depending on your time horizon and just sort of what it is that, what your sort of investing methodology is. One of those is probably you can drill down from there. That's all I've got today. Thank you all for coming. This session was recorded. We'll send out the recording sometime tomorrow. By all means, keep the questions coming. You can hit the help button on the website if you have questions at any point. The next workshop will be 3 weeks from today, which is, I think we're going to call that July the 15th. So yeah, that is that. Thank you all for coming, and yeah, good luck investing.